What's up, YouTube? It's Joe Catchpolia sitting on the couch, making some money, investing in fractional real estate online as usual. Today, I'm going to try to dig into one of the misunderstandings that I think a lot of investors have on Lofty that's leading them to lose money, and is one of the things that, struck me pretty early on and has made it, most of my most profitable deals have been ones where I bought properties on the platform and then we've gone and sold those properties in real life off platform. Um, Here's an example of one of those that we're in the process of. I've been buying tokens in this one for a few months. My average token price is $23.98. Very cheap, right? We actually have it under contract right now, and the numbers have changed a little bit, but I expect to get somewhere around, 39, 38, 39, $40 per token on the sale. That's a huge price difference, right? One of the things uh, people, one of the reasons a lot of people think, well, no, we should just hold this token. This is one of the arguments that I have over and over again, is that if we just held these tokens and turned the properties around, that they'd all be worth $50 again, right? Because somebody paid $50 for these tokens to begin with, and there was appraisals that said the property was worth that much. Although based on our real world sale, I think that's probably not true, right? It's probably worth a little bit less. But regardless, why, I'm sorry, a lot of people are having a hard time understanding why this token price ends up being so much different from the purchase price. And then on some properties, it goes the other way, right? Some properties, like for example, 90 Madison, uh, if you look at the token price, and this is probably 88 Madison is a better example. If you look at the token price, let's see, is this 88? Is this the one I'm thinking of? Yeah, there's tokens at $70. If you look at that price compared to what that property would appraise for in real life, there's a big premium, and so uh, a lot of people, are kind of stuck on this idea that the token price should mimic the real world price, and I just don't believe that that's the case, and I'm going to explain why and this is going to get I'm going to try to not be too nerdy about it, but we'll see what happens. So the $50 token price is always based on an appraised value, and it might be we're adding 5% to the appraised value, but we're going to do guerrilla math today. Everything's going to be overly simplified, just to try to get the point across. So let's say, your property's appraising at $50 a token. But why is it what's based, where's that appraisal come from? Well, all of these are residential properties that we're dealing with. And so appraisers aren't doing an income approach to value, or if they are, it's really a secondary approach. Usually they're doing a sales comparable approach, and they might do a cost approach, but again, that'll be a secondary thing. For the most part, residential properties, especially single family homes, but even the small residentials, duplexes and fourplexes, you're getting the sales comparables is the main tool that appraisers are using to create a value. Well, those sales comparables are just based on other sales in the marketplace, and those sales, the prices and prices in general, are created by an interaction of supply and demand. And so this is, I don't know if you guys know who this guy John Burns is. He's, if you don't read any of his stuff, he's got some pretty good details. I'm actually just on his site because he has one of the best images that I could find for showing the different, where the supply and demand comes from, and how there's, some of these, uh, if you know anything about economics, and if you don't, I'd encourage you to just try to learn a little bit of the basics. But when you have supply and demand setting prices, the price is actually set by what they call the marginal buyer and the marginal seller. And so, usually sellers and buyers start far apart, and the seller that's willing to sell their property for the cheapest and the buyer that's willing to pay the most, those are the ones that match up, right? And so those are the marginal buyers and sellers. And so in every market, the marginal buyers and sellers are going to be different, right? And so, he's talking about who those are going to be, right? In some markets, it's going to be first-time home buyers are going to be the marginal buyer. Sometimes it's going to be people moving in, people moving up or down. The It's because we all have different motivations. They all have different financial means. And I don't know that that's even what he's talking about in this article. So if you look up this article, and that's not really what he's describing. I actually just picked this one today because I remembered the picture, and I think that it's really useful to think about this. And so, in the same thing for sellers, right? They talk about end of life. Well, yeah, a lot of times when you're buying properties that are owned by an estate, you're getting a better deal. If you're buying bank-owned properties, you're getting a better deal. A lot of times, builders are in today's market, builders are actually selling cheaper than a lot of people that are, holding their homes because they have a low mortgage rate. And so that balance of supply and demand, you can see there's investors on both sides of that. But in most markets, investors aren't the marginal buyers and sellers. Um, most homes are owner occupants, and even a home property like this, which is a multifamily property. This is, I think, the third one in Chicago that I'm selling since I got on Lofty. And the listing agent on the last one and on this one both times has mentioned that they're really trying to keep a unit empty because they're primarily selling them to unit or to owner occupants. It's somebody who's trying to get uh, live in one unit and rent out the others. One of the in a lot of markets, owner occupants are willing to pay a higher price than someone who's just buying it for a pure investment. That happens for a lot of different reasons. One of them, primarily it's because they get more favorable financing, but it might also be that they're not as number driven. And so the interaction of all of these people in the marketplace is what creates your price in the market, which is what your appraised value is at. So that's where the $50 comes from, right? But you can imagine that in most markets, at any given time, you can't just buy any home at its appraised value and make money with it as an investment. So if you've been following me a while, my day job, I have a real estate agent team in San Antonio, Texas. All we do is work with investors, and we spend all day, every day looking for deals for investors. At any given time, there's about 10,000 listings on the MLS. And if my team finds five great deals in a month, I'm excited about that. That's a good month for us, right? So it's not as if you can just take any home off the shelf, turn it into a rental home, and it's going to make money. But those homes are all selling for their appraised value, right? And so the difference between the home that's a good investment and a home that's just selling at its appraised value is often, so there's a couple of things, right? It might be uh, so let's get into some math about this, right? So like if I'm thinking about yeah, and this, don't be overwhelmed by this. There's a lot of lines, but I'm going to go through it one at a time. So if I'm an investor and I have a specific return I'm going for, and so no matter what the combination of factors are, I want my return to be the same. If and again, I'm going to oversimplify. We're assuming the risk level is the same in all these properties, and so I'm looking for a 20% IRR. That's the internal rate of return. Honestly, I think that that is higher return than you're going to get on most of these deals. But because you see a lot of people chasing the 20% yields, I just picked that number on this on here. So what's one way to get there, right? So I buy the home for $50, and I'm just pretending it's the whole home at the token price because it makes it a little bit easier. I'm getting a 20% rental yield, which would be $10, $10 a year, $10, divided by 50. That's your 20. That's how you get your 20% rental yield. It's the other way around. I don't know, but it's $10 is 20% of $50, right? And so one way to get a 20% IRR is if you bought bought the tokens or bought the home, $50, no appreciation. I'm just using a 5-year hold that it works with any hold period. The math might just change a little bit. But so, okay, I'm in a market, I buy a home, I don't expect it to appreciate, but I'm getting a 20% yield. Over time, after I sell it, I've made a 20% IRR. You could do the opposite. You could buy a property that is making no money at all, right? You're making no cash flow. And I'm putting rent because on Lofty, the payout that we get each month, we call it rent, but it's really NOI or our cash flow. It's really our cash flow. But I'm just calling it rent here because that's the terminology we use on Lofty. Um, so you can imagine a token that's getting zero cash flow because um, the rents barely cover the expenses, the taxes, insurance, the maintenance, the management, all that. We're getting zero yield, but we're in a market with 20% appreciation. So we buy the token or buy the property for $50. 5 years go by, we sell it for $124.42. That's just 20% compounded annually. And then, okay, bam, we've got our, again, 20% IRR. So that's two ways we can do it. More likely, we're in a market where we see, some of our return comes from the rent or cash flow, and some of the return comes from appreciation. I mean, again, I think that this is, to think that you're getting a 20% appreciation or even 11% appreciation is a little, it's very ambitious, but I think the 20% is ambitious. But at the same time, if these are levered deals and you're getting levered appreciation, I think you could get there. But again, you're on Lofty, we're not really getting the levered appreciation, we're getting levered yield. But again, I'm overcomplicating it. So that's another way, right? I can spend $50, get $5 in rent every month or every year, sell it at the end of year 5 for, and really this is, I'd selling it for $87.20, because I'm subtracting $5 plus getting the $5 that last year. Again, that gets us 20% return. But then what happens if that same property, you're going to get 5% rent and you're in a market with zero appreciation? It's worth $50 today, but if I paid $50, I'd only make a 10% return, right? So what do I have to do? So I'm getting that $5 every year. I'm getting no appreciation at the end. The market price I'm going to sell it at is $50. So then that last year I get $55, the rent plus the market price. And again, we're ignoring fees and everything. I'm just trying to make this as simple as possible. So the only way, right, if I paid the market price today, this all of a sudden becomes a bad investment, right? I'm only making half the return that I'm making on these other properties. Well, the way to fix that is with a price change, right? So I have to buy this property, or I have to buy the token at a discount. And actually, I do this this happens in real life too. When you're buying, when investors buy properties, there's a couple different ways they do it, right? There have been times in my career where if you found a well-located property, you could pay market value for it, and it was a good investment. If you had, with the right financing, the right location, the right, there was a time here in town where you could buy a fourplex, with financing. You and the where the rents were and the prices were, you were getting a nice cash flow. And because this is a market that people expect strong appreciation over the long term, you'd have people just buying at market rates, at market prices, and being perfectly happy with that property as an investment. In today's world, where prices have moved up, interest rates have moved up, but rents haven't, uh, you're you're not getting those pure investors buying those same fourplexes. You're getting mostly either owner occupants, um, or you're getting somebody who's looking for a discount, right? So that happens both in real life, and with the tokens. The difference is, the in the world on Lofty, nobody is buying these as an owner occupant. They're all buying it just as an investment, and so. But the buyer of that property in the real world might be an owner occupant, and so they're, as a marginal buyer, willing to pay more than what an investor would pay. So this is just one example, right? If you're getting the lower rent and no appreciation, or you're getting no cash flow, but you're getting a stronger appreciation, but not as strong as your 20%. Again, you have to pay. And there's nothing magical about this $35 price. I mean, I just did some goal seek and to get it to where they're all yielding the same amount. And the same thing, right? If you have a little bit of rent but no appreciation, You have a situation where you have to pay even less. But so I'd have to pay $27.57 for this token if I believe in the future we're going to sell the property in real life and get the $50 sale plus the 250 in rent I've gotten each time, right? And so um that's why it is rational. It's so that's why, like, a lot of people keep saying, well, no, the property's worth $50 per token, the tokens should be selling at $50 per token, but that property value is not it's not the value of it as an investment, right? Is not every property makes sense as an investment at its appraised value, but every property that's coming onto Lofty, for the most part, is being brought on here at appraised value or higher. And so this is, I think, a large part why you see, um, if you watched yesterday's video, and if you didn't, I'd encourage you to take a look at that. It's just about how um, most of the properties on Lofty are trading at a discount to the $50 par value. Uh, but for the same reason, you'll see some of these that are trading at a premium, right? And it's because some of them are commercial properties like and I think there's a couple other things going on too. I think on Lofty, uh, there's some things happening here. So one of the things about this, your income, your cash flow, and your appreciation is that these are forward looking, right? Like, I'm trying to figure out what this is going to be in the future. And so, if we all knew the future, rational investors would pay the same amount of money for every single property, right? Or not for every property, but every single investor would be willing to pay the same price for each property. But we all make different assumptions about what the future cash flow is and what the future appreciation is going to be. And so it makes it so we pick different properties. But in addition to that, I think that we have a large number of, I don't want to say uneducated investors, but a large number of investors on Lofty that don't understand a lot of what we're talking about today, right? They don't understand that the price that you pay. I think that a lot of us intuitively know this, but maybe haven't thought it through. That the amount that you pay um, today is the one thing that we control as far as our returns for the property for the future, right? I mean, there are certain business models that you can do, like, for example, switching to a rent by the room or switching to short-term rental to increase the cash flow. But in general, the thing that us as investors have the most control over is the price that we pay, right? Because the market appreciation is going to be what it is. Sometimes we might be able to force some appreciation with a renovation or a repositioning, but that's not what we're doing most of the time here. And so the only lever that we have to change our return is to change what we're paying for that token. Um, and so, but one of the problems, I think, a lot of the people that are, is to change the price, but then we're also, living in a world where we're having to predict the cash flow and predict what that appreciation is going to look like in order to price it. Now, I think that where a lot of people go wrong is they I don't want to pick that one because I feel like it's probably a little bit better. Yeah, so they'll open up a particular property. It'll say, projected rental yield 26%. And at a certain time, the actual rental yield was higher as well, right? And they'll look at that and they'll use that as their assumption when figuring out, is this a deal or is it not a deal? But unfortunately, this rental yield over time, it's almost never it never matches the projected rental yield, right? Because if you look at what this is like an ideal yield where there's no vacancy, you're not doing any sort of repairs or anything that month, and so you're never going to average this projected yield. And that's one of my problems with the way they project yields, is they're not doing it the way really anybody in the real estate investment space would underwrite a projected yield, because they're ignoring those factors. But uh, and unfortunately, that's, I think, a lot of the people, when they're comparing one property to another, that's one of the main things they're doing, is they're looking at, well, what is it yielding last month, because that's all this number is, or what is the projected yield. And that's how they're making these comparisons and deciding whether to pay this or not. I think, Lofty does give us a projection as far as appreciation, projected appreciation. It's 0 on this one. Uh, you know, uh, Whether or not your people are paying a lot of attention to that, I don't think that they are, right? So we're getting a situation where, um, if I were just looking at a pure investment and I was looking at it rationally, uh, I'd make certain assumptions. But then if our average market participant on this site is just taking certain data as a fact, right? Certain projections as, oh, that's actually what it's going to be. Especially new people to the site, very often I think come on here, look at the projected yield, and if it's the first month the property's up and their regular, and their actual yield is the same at that point in time, um, I think a lot of people are just falling for that. Basically, they're like, oh, okay, that's what this is going to yield, and so then that's how they're comparing the investments. And so because we have this sort of base of investors, because it's a very inefficient market, right? This is not a market that has tons of institutional capital or a ton of capital where you don't have family offices investing here, where the market prices are really driven by these um, very studied market makers who understand the supply and demand and the projections. You're for the most part getting, I mean, I don't want to say like just crypto degenerates, but I think that there's a decent number of them, and that that's in my mind, right? Because I come from the world of a very conservative world of real estate investing, right? And so the way I see people looking at these deals and pricing them is it's really hard for me to get behind sometimes. I think over time, provided we get better deals on the platform. And by better, I mean deals that at $50 actually make it for good investment properties. The more properties we find like that, and even better, ones that at $50, at $60 or some number higher than what we're paying would still be a good investment property. The more people, the more deals like that we get, the more you'll attract some educated, well financed real estate investors who, I mean, so one of the things that's kind of weird about this site, if I just took my clients that my team sold properties to last year, the volume that we did, in 2 years or 2.5 years equals about, or last year, yeah, no, I that's not even true. Um, what do they have their total volume? I know they have it on here. Total market cap, I think. Maybe they don't have it here. Maybe it's on the Lofty Assist tool. Um, but I mean, my team probably sells more in dollars worth of investment properties than what are on this site every single year. And it's not we don't have hundreds of investors. I mean, you could have a handful of investors that, if these were all fantastic deals, would provide 100% of the liquidity for Lofty's site. And so, I'm not saying that to like brag about my team. Like we do a good job, but there's nothing special. Like in every market, you can find, teams or even individuals that are selling at least that much money worth of real estate to investors in any given year. And so, there's a lot of money out there for good investment properties. And I think, unfortunately, a lot of the people that get here with the understanding of what a good deal looks like look at the average deal on this site and they're like, why would I ever invest on this platform? And it's because a lot of the deals that you see here they're ones that you'll make a lot of money with at this maybe 25, maybe 35, maybe $15 purchase price. But they keep getting brought to the platform at 50. Um, part of the problem, part of the reason I think it happens is because the incentives of the people bringing the properties to the platform. I think one of the things that will start to change that is when you have more people using Lofty as a capital raising, kind of like what Earl is doing with the Hawaii property right now, right? Like he identified the property, he's raising money on Lofty to buy it. Um, that one's a little bit odd because he's now, a lot of those tokens are selling for even above the $50 price point, well above. And it's because the financing is very favorable for a very highly levered yield. So I don't know that that's a perfect example, but in general, when you have people that own these properties already, and then they're going to bring it to Lofty to recapitalize, if they're allowed to, um, come in at 5% over the appraised value, and at the moment, the typical investor is willing to pay that on here because honestly, I don't know why, right? Because I think because there's this misunderstanding of how this math works, um, then you're always going to have a situation where over time you should have a dip in prices on average, except for and that's, this is not to say that this is true for every deal, right? I mean, there are plenty of properties on this platform. It's just not the majority of them, right? But there are several properties on the platform that do make a lot of sense from an investment standpoint, that are paying out a very good yield, that are in a market where you'd expect to get some appreciation. I think some of them, if people are really doing math, they wouldn't be buying these, 70 or $75 tokens, um, unless they, I think they wouldn't do it if they were really looking at what their internal rate of return is and understanding what their yield looks like going forward for the long term. So I think part of our pricing problem comes from, um, market participants just just not understanding the math of investing, which is, but again, it's because it's a very inefficient market. It's a very small market. I think it's why there is a ton of potential to make unbelievably good returns on here. Like, on that first one that I showed today, this Avenue L, uh, this is going to be another one where I get, assuming this sale goes through, it'll be a 30 or 40% ROI, and then, yeah, on an XIRR basis, this will be another one that is probably, from an annualized return, um, approaching 100%. I don't think it will be 100%, but I think it'll be getting close to there, depending on how long it takes for the sale to go through. And I'll have to go and back and look at, like, when did I buy the first tokens in there. And so deals like this wouldn't exist, if everybody was really doing the math on it, right? And so that's an advantage. But the other thing is too is people aren't taking advantage of when we get these really big dips. When we have these $15 or $20, like almost every single one of these, the path to the highest return would be to just sell the property. Maybe it's to do a little renovation and then sell. Maybe it's to just sell as is. Um, but the issue there is that you're just going to, the return that you would get on that, and then reinvesting into a better property on here is just so much greater than, hoping that this turns back into a $50 property. Because the thing is, even if it's operating, even if it's paying out rent, operating perfectly fine, there's still a very good chance that that token's not worth $50 as an investment, because when you look at the actual, the actual yield it's going to pay out and what you think it will appreciate in your future sale, you just the value as an investment is just not equal to the value of that property in real life. Um, so I don't know. I know I've sort of talked around this a whole bunch, but like basically it's, well, oh, I always forget. Well, I've been doing better, but please like and subscribe. If you want to talk more about this, there's a link in the description to this video, to the Discord channel that I've set up. That's just generic fractional real estate investors talking. We talk about Lofty, Mogul, Ground Floor, a little bit of Collab, Arrived, all Saul's Law, a lot of different discussions on there. Um, it's not a sales funnel. Nobody's trying to pitch you anything in there. I try to delete the spam. And then there's also links to all the places that I am currently investing in the description to this video. Again, uh, do your own due diligence on the sites and on the properties. Just because I'm making money on them does not mean that you will. This takes a lot of, and honestly, and I'm going to lose money on some of the stuff I bought. It's not like it's 100% win rate either, but it's something that you have to really do your due diligence, understand what's the value of that property, and then separately, what's the value of the token. And so this is why we have these fantastic arbitrage opportunities, right, to buy the token and sell the property. Um, but then on the other end of it, that's why when we have some of these very high priced ones, is what we're seeing is people taking advantage of the opposite arbitrage, right? Like I can buy a certain property in real life and I can sell tokens at significantly higher price, um, because of the way that people are pricing tokens versus the way properties are priced in real life. Um, Hopefully that gets that point across. The other real sticking point that I think people have with this is if you own a $15 token, but you paid $50 for it, you're trapped in sort of a sunk cost mindset, right? You're like, oh, I don't want to lose money. People don't think they've lost money until they sell. But if you have a $15 token that you paid $50 for, you lost money when you bought it, right? Because that was never the value of that token. You probably should have never paid $50 for it. Maybe it was worth something more than the 15, but it is, uh, it's a disconnect between what that property is worth as an investment versus what it's worth in the marketplace in general. Because again, maybe that marginal buyer, the person who's going to buy it in real life, is somebody who's buying they're downsizing, they're upsizing, they're buying a separate home, they're getting divorced and they're buying a second home, or there's, for all these reasons, you have uh, people that need to buy a home in real life, and they will often be somebody who's willing to pay more than what an investor would pay for that property. And there are times that it's opposite, right? There's times that the highest bidder on a specific property will be an investor, and it just depends on, well, it depends on a whole bunch of different things, and this math is a big part of it. So, for example, here in San Antonio, almost every 5+ bedroom home with a pool is being bought by an investor today, versus an owner occupant. I say almost all, but a whole bunch of them, because the way our short-term rental market works here is those homes make a lot of money. And if you pick the right home, and even with today's financing, like people are making money buying those, and because there's not a lot of other options for investors, you see them bidding up those pool properties more than they are a lot of other stuff here, where almost everything else, the marginal buyer is going to be in some sort of owner occupant. Um, Hopefully I made all this a little bit more clear and not just more confusing. There is definitely a lot that goes into properly assessing what you should invest, when you're buying a property, what you should be willing to pay for it. And it should have to do with both what you expect your future cash flow and future appreciation looks like, right? And if you're not thinking about those two things, um, and you're only looking at what was last month's yield, I think that's where you're just going to end up getting hurt in the long run. And in any case, that's all I think that I have for today. Um, Hopefully, I didn't get a little bit too nerdy. I mean, this is this kind of stuff I love. I do have um, I've got a master's degree in land economics and real estate, and there's just not a lot of fun jobs that you can do using that, other than, a lot of us went into real estate investing and development and stuff like that. But it is like you don't get to have like the real good nerdy conversations on a daily basis that were, what attracted me to that type of program. Um, I don't remember why I even brought that up. Sorry, I'm just going to end this. I always do this, right? And I apologize. I'm going to really work on my outros. I was watching some videos about outros, and so my YouTubing skills, I realize are terrible. I'm sorry I'm not better looking. I'd really like to just, and more articulate. I know I tend to ramble, but I am working on it. Hopefully, if you watch this video and you compare it to some of my earlier stuff, that this is a little bit better. I know some of them just tend to go on and on like I'm doing right now. But anyway, that's it. So until next time, I'm going to just keep making mistakes so that you don't have to.